What's going on, everybody? They say fortune favors the brave, and you got to be a little bit brave to step in front of this big down day that we're seeing today. What a surprise, huh? I mean, I tell you, this year's not going out without a fight. This is going to be a memorable year. We're all going to talk about how rough 2022 was. And naturally so. It's been really crazy. We've shown so many statistics. We forget about it at times. The amount of 2% days down, the amount of 3% days down, the amount of intraday ranges that we've seen. And this just adds on to it. Very surprising. And, well, who's to blame here today? You know who's to blame? I blame you guys. I blame myself. We accepted those stimulus payments. They handed them out, and it created inflation like you've never seen before. Well, at least you hadn't seen it in 40 years. And so now the chickens are coming home to roost, as they say. Yeah. Now all of these central banks are just hiking rates, and they're going to keep hiking rates for the foreseeable future. At least that's what they're continuing to say. Even if they do smaller rate hikes, still a rate hike. It still affects credit, still affects debt, still affects so many other things in our economy and our society. And so we got to talk a little bit about the Fed. We got to talk about ECB. Of course, there was a bunch of different rate hikes that came out today, ECB and Bank of England also. So we got to talk about that. And the decline that we're starting to see in more and more of these macro indicators. But in the meantime, my name is Jamal Chandler. Welcome to the most dangerous show on the Tasty Live Network. It's Engineering the Trade. And yes, we are down a full 100 points. You know, we've seen 100 points down a couple of different times this year. And I know, 100 points is always relative, right? 100 points is a whole lot bigger move 10 years ago than it is now. But still, this is really interesting to watch today, and to some degree surprising because, again, the Fed really hasn't changed. They never really changed course of what they've been saying. They've been fairly hawkish for some time now. And for whatever reason, we try to read into these things that we see, the data that we think the Fed is looking at, and say, oh, they're going to run into some trouble here. They might have to pivot at some point. But they haven't said it. They haven't come out and said it. Did we get a little bit ahead of ourselves? I didn't feel like it this recent time. But and here we are, down 2.5%. It's an ugly day. Let's pull up some slides. Let's talk a little bit. We'll get to the platform. I'll try and find a couple of trades that make sense on a day like this. I've rearranged a couple of things now. Please, if you're looking at the show on the Tasty Live Network, or I should say the Tasty Live webpage, come on into the Tasty Live YouTube page. Check that out. There's always a poll that I'll have up. Today, the poll is, which way is your delta leaning here? What do you like from here? Do you want to get long? Do you want to be short? Do you want to be neutral? Do you have no position right now? I could literally understand all of them at this point in time. So yeah, hop on in the YouTube page and take a look at the chat. A couple of people. My main man, Grumpy Mike, is here. What's up, dude? You're always there when I need you. Evan, how you doing, buddy? Love to see you in the chat as usual. George B, what's up, dude? Yeah, it's an ugly day. And of course, a lot of it started yesterday. I mean, we had some fluctuation after the what we saw with, again, we did have a really exciting day on Tuesday, right? When the CPI came out, markets really got excited about the fact that we still have 7% inflation. That's the best way to look at that, right? And then we had this Fed meeting yesterday, which again, coming into the day, there was SPY at the money, SPX, however you want to look at it. Markets were pricing initially a 2% move in either direction. And then it calmed down some, actually. It was pricing a 2% move in either direction late Tuesday. By the time we got to Wednesday morning and markets opened, it was only about a 1.5% move. And that kind of lived up to it. I mean, we did, kind of jostle around a little bit in the market, but it ended up being fairly muted reaction, I would say. Certainly figured that whatever move we were going to get already happened yesterday. And then lo and behold, we come in today and we get this huge move that is fairly unexpected. I don't think anybody kind of saw this coming. Of course, we raised another 50 basis points yesterday, and we got to, where are we now? We're at 4.25% to 4.5%, right? Most people have been thinking that the Fed is going to stop at 5%, but, Powell said, among other things, we still have a ways to go. And the market didn't like that much, right? If you're looking forward, and the one way to always do that when you're looking at this idea of, I mean, we've all become yield and rate hike experts now, right? Now the next rate hike coming is February. Of course, we'll have a jobs report. We'll have maybe one. It's coming on February 1st, so we won't have the jobs report in February prior to the next rate. Well, let's just call it rate hike. We can say rate meeting, but we might as well call them rate hike meetings, right? That's all we've been getting more recently. And so January, there's no Fed meeting, but there will be obviously a lot of data that they're going to parse through. It'll be a jobs report. There will be a CPI report. I mean, there'll be, initial jobless claims. And it's there's little doubt that there's going to be a rate hike in February as well. It might be smaller. A lot of people are thinking 25 basis points. But you know how these things go. By the time we get to late January, there's going to be some fluctuations in rate hike expectations, and I'm pretty sure we're going to be looking at a potential chance of 50 basis points. Who knows, man? It all depends on how bad things are, and inflation is real. Most of us who have complained about, and I say us because, we're all in this together. Most of us who've complained about how high prices have been and things and inflation and all that, well, this is the way they're going to push it down, right? But again, you can argue that the Fed creates this situation. Now, they did it because they were helping and make sure everybody, the economy was stable and safe and all of that. But, it's starting to get to a point now where you wonder if markets can handle higher rates, and particularly if a lot of these tech stocks are going to be able to withstand higher rate hikes that are coming and coming and coming. BOE and ECB both hiked 50 basis points today in ECB. I mean, pretty much similar message across the board. They're finally admitting now that they have some serious inflation. Over the last several months, they started to admit it. The beginning of the year, they were just like, nah, everything is fine. This is good. You know that meme where the dog is sitting at a desk and there's just fire everywhere? And it's like, this is fine. That's what those guys were saying for the longest time. But they finally had to admit to the fact that there's going to be more pain ahead, and we have some serious issues coming. And all of this clearly affects the markets, right? That's why we got to talk about this macro stuff. I don't enjoy talking about the Fed. I don't enjoy talking about the Bank of England or the ECB. But this is what's moving markets. This is what moving markets. And my promise and pledge to you is to always talk to you about what's moving markets. Nothing more, nothing less. Retail sales, not good, apparently. And they have been decent, surprisingly. I'll be honest with you. I've been waiting for a bad retail sales. Let's just be straight up here. I've been waiting for a bad retail sales number because that means people aren't buying as much stuff. I would imagine retail sales are going to be better next month because people are probably buying stuff this month. I mean, it's that season, right? But retail sales apparently weren't that good, and initial jobless claims were a little bit lower. It's another thing that I expect to continue to deteriorate. So, yeah, it's kind of bad news all the way around today. I'm sorry, guys. I don't really have much good stuff for you, but one thing you can hang your hat on is that anytime we're going to keep hiking rates, you can try and predict when a pivot is going to happen. This is one of the reasons why we have a lot of the trading measures that we do, a lot of the trading mantras, the idea of trading small and trading often, the idea of paying attention to not over allocating too much when VIX is fairly low. Talked about this last week on the Friday show. For those of you who watch, of course, there's more of you who watch the morning show than watching me. And every now and again, you see me pop up there and talk to Tom and Tony and or whoever else may be filling in at that point in time. This week in stocks, we talked about the idea of where volatility currently was at the time when it was, just under 20. It just probably wasn't the best areas to be selling vol. This is why. I mean, you get these unexpected moves out of nowhere, and those are the things that give you the vol pops. And these other times, maybe you might be a little bit more interested in trading some and selling vol because you just don't know when these days are going to come up. Looks like we're trying to rally a little bit. I don't know how much I believe it. Just to break for a second. Leftovers. How important is the holiday season to retailers? Talking about retail sales, talking about people spending. Let's move to the next slide and take a look. So we got department stores, we got hobby toy and game stores, we got gift and souvenir stores, we got clothing stores, you got electronic stores. I took the liberty of putting just a little bit of divider there between things that rely 30% and those that don't. This is a chart looking at the share of annual retail sales generated in the fourth quarter alone. This one's from 2021. So you can see department stores, they really rely on, I mean, it's a third of their revenue, or I should say third of their revenue sales, whatever. It's a third of their sales that come from, more than a third of their sales that come from, almost 35% of their sales come from the fourth quarter. Hobby, toy, and game stores, 34%. I mean, these are the areas that people are going to later in the year, particularly, probably. I bet, when you talk about fourth quarter, I bet this heavily skews to December, November, December, right? You would imagine. Gift and souvenir stores, 32% of their sales are generated in the fourth quarter. Clothing stores, 30%. Electronic stores, 30%, right? Oh, I gotta. Just as a quick aside here in the YouTube chat, Craig G, you're absolutely right. I just was saying this to the guys at the table a little bit ago. This is the most boring down 3% day I've ever seen. I completely agree. Back to the chart. Discount stores, 29.7% of their annual retail sales comes from the fourth quarter. Non-store retailers, 29.2%. Bookstores, 28.9%. Beer, wine, and liquor stores, 27.8% of their annual retail sales are generated in the fourth quarter. I mean, people are drinking it up. You know, the holidays are tough times. We talked, one of our recent leftovers, I think the other day, was the idea of what stresses you out during the later in the year, and it's about the buying presents. What stresses you out about the holidays? Buying presents was one of the bigger stressors. Sporting goods stores, 27.6% of their annual retail sales is generated in the fourth quarter. I find that interesting. That many people are shopping at sporting goods stores? I need to go, actually. I need to buy some basketball shoes for my kid. We're going to be in 2 leagues. Yeah, we're going to be in 2 leagues. We have 2, only because it's not so much, you know, it's not because I love basketball so much, or he doesn't either. He actually loves football the most. But we're going to do 2 leagues because our 2 towns, they feed into one high school. We have 2 towns. They're really close. But everybody doesn't always interact. So we're going to, you know, interact with a bunch of people. So it's going to be great. Yeah, I'm going to be coaching 2 leagues. Hopefully I don't lose my mind. So in a few months here, when I start talking about basketball, there's going to be 2 leagues I'm going to be talking about at times, just so you know. Let's move ahead to the first slide. Next slide. Not the first. The first should be next. You know what? Shout out somebody here, Mr. Victor Jones. He actually put me onto this. I wasn't paying attention to it a whole lot, but you know what? Gold and the 30-year bonds, they've been kind of highly correlated this year. They're at a 0.5 correlation right now, which is always pretty decent. They've been moving together. If you've noticed, they've been moving together to some degree. Now, today is interesting. It's a little bit departure from the usual today. If you look at the very far right, very tip of this thing, obviously gold is down today and the bonds are actually up. And I'm fine with that. Bonds, this was the traditional thing that we got used to. This is the reason why you have a 60-40 portfolio that exists. Bonds usually move up on a day like this, right? And that allows you to be able to balance the 2 out. But for most of this year, it hasn't quite worked that way. As we know, anytime yields have been up, which are the opposite of bond prices, yields have been up and the market has been down. And then when the market's been up, bonds have still been down. So it's been kind of one of those years for bonds. It's been a really tough one, as much of you have talked about and know. So kind of interesting. Let's move ahead to the next slide as I take a look at a question here. John, 2021. How much of today's move is related to monthly options expiration tomorrow? I don't think anything. I don't think much of it at all. I think this move has more to do with, I don't know. It's just me. Just me personally, I think this move has more to do with digesting what these central banks have done. And it's really making people nervous today. You know what I mean? You got any other questions here? Yeah, can I play Smack Lovin'? Can I explain my thought process on the mRNA? I will in a little bit. Yep, I'll get to that. When we get to the platform, I'll discuss that a little bit. You know what I'm saying? 10-year and 3-month yield. As we know, near-term yields have been ridiculously high. 3-month, 6-month, 1 year, 2 year, all of them. And the 10-year, of course, has been really getting smacked as of recently. These are one of the things that make people talk about the R word, recession. You look at the difference in these yields, you look at the difference in near-term versus long-term. And we know near-terms have been way higher than long-term. This one is particularly interesting because there's usually a high success rate of a recession when this thing is inverted. And it's fairly inverted, as you can see right now. It's been inverted over 50 basis points for the 15 consecutive days here. So it, I don't, obviously, it means something if something is inverted for this long. It means that obviously near-term yields are continuing to go higher, or farther-term yields are continuing to go lower. There's just a big dislocation between the two. You can see other recent times. 2007, of course, was one where it was I think it was about 10 days, I believe. Looks like bigger than that, but I don't know. And then 2001, actually, it was also fairly inverted, so other times of recessions. So just so you know. It's a predictor of some serious recessions. I think we can expect one to come. And, there's a playbook for recessions, right? I actually had this good conversation with my guest on Monday, Dan Deming, about different trades you can look at during recessionary time periods. Those are the times where you get a little more conservative, generally, with trades, and even with option trades, you can do that. That's where you're looking probably more at covered calls, or you could possibly even do a poor man's covered call if you haven't heard of many of those. Going further out, getting long, higher delta options, call options. If you want to do, long, if you want to get long, or you can also, I should say, if you want to get long deltas, then you would do a further out long call option and sell a nearer term long call option. You don't ever want to do it more than 3 months wide. Or if you want to get short deltas, you can do a put poor man's covered call. This doesn't have to be limited. I guess you don't call it a poor man's covered put, really. I guess PMCP, whatever. Let's move ahead to the next slide. We're bid. Vol is bid. The front end of the SPY vol curve remains elevated after the FOMC. I usually put a couple of things on here, but there's really not much left for the rest of the year. We do have the jobs report coming up in, when is that? The 22 days. So the 22 days of expiration, that should be the week that we have that's Jan 6th. So we should have a jobs report there. Really no elevation in vol right now. Outside of today, and today's elevated. I should say this is not today. This is for tomorrow expiration. That's a little bit elevated there when you look at it. But outside of that, I think you can expect, fairly quiet markets, I think, but who knows? I really don't know. But yeah, it's still pretty elevated looking at today, and clearly this move has really exacerbated vol on the SPY curve just a little bit. Let's move ahead to the next slide. Earnings, we got Adobe, we got Accenture, we got Darden Restaurants, and then you got Winnebago. Winnebago is kind of interesting. I don't think people are traveling by RV as much. Remember when that was a big, big deal in 2020 and 2021? Nobody wanted to get out of there. You didn't want to get out of your own space and interact with people. You just wanted to travel, though. Not sure what's going on with that stock. We'll take a look at least Adobe probably and look and see what the earnings straddle is. I don't plan on trading it, though. Odds of no May rate hike is 75%. Market is saying 4.75 to 5% and done. What does that mean? We just talked about, when you look at this CME Fed tool, which is always interesting because you can get an idea of where they're expecting to do for rate hikes, right? If you look at that, you'll see right now that the February meeting, there is a 72% chance of a 25 basis point hike, right? So right now we're at 4.25 to 4.5. The next tranche, if we get a 25 basis point hike, will be 4.5 to 4.75, right? If you go to March, the highest chance of a rate hike right now, that would be another 25 basis points. So they're expecting another 25 basis points of rate hikes for February. They're expecting another 25 basis points of rate hikes for May. And then for May, guess what? They are theoretically, as of right now, thinking that we're not going to have a rate hike. Now, you and I both know that could easily change when time comes. But for now, that's kind of how it's looking. We'll see what ends up happening. Binance saw $1.9 billion in withdrawals in 24 hours. I don't know how much that's a reflection on Binance as it is a reflection on the current feeling behind the industry and behind that area of the industry right now. So something to keep in mind. Triple witching is, of course, coming up tomorrow. Seems like today kind of took a lot of the steam out of it. I don't really know how much more we could see, unless for some reason, which is partly why the market might be rallying right now, they just really want to hand it to us tomorrow and take this thing really far below 3,900. That's the real next test. Number of S&P 500 stocks above the 50-day moving average, 328, only 65% now. Remember when this thing was at 90% in the last week, 10 days ago? My, how the mighty have fallen. Let's move ahead to the platform, please. Uh-oh. Spammer in the chat. People. People. So when we're looking at today, we got a big move, of course. Let's look at for tomorrow, theoretically, what we can expect for markets, for SPOOs. 4.87. That's a little more than 1%, right? About a 1.3% move or something like that. That's just a guesstimation. We'll see what ends up happening. And of course, when I say 1.4%, looking at this straddle, this is in either direction. Isn't it a little weird right now? Guess what, people? Good time to talk about how options work. Do you guys know what the delta is, right? 50 delta. Delta is the chance of something winding up in the money, right? Right now, this is a 57 delta, 57% chance that this 390 call will wind up in the money with SPY trading 390.80. Can anybody tell me why this market is 195 and 196, but the put market, which is out of the money when you look at 46% chance, why is this put value higher? Anybody? Bueller? The reason why is because we have a dividend tomorrow. That's right. If you follow the great Tony Batista, you'll know SPY goes ex-dividend. And so that's the reason why this right here, even though it's a 46 delta, it is a higher value on this put market than it is on this call market. So keep that in mind. If you have any near-term options that are in the money calls, you might want to close those out because otherwise you will get, obviously, if you're long it, it's not good. You don't want to be there because obviously at the very least, SPY is going to be trading $1.70 lower than the stock price will suggest tomorrow because of the dividend. So keep that in mind. And if you're short any calls, you're going to have to make a decision by the end of the day whether you need to close it or not. So something to keep in mind. If you're not sure about it, of course, contact our Tasteworks team. They'll let you know what the deal is. You probably already are getting stuff about it in your email anyway if you weren't. So let me address the question. I know somebody asked me about my mRNA spread. So they wanted to know what the thought process was by getting long mRNA. Well, I'll tell you what, it's been on the move recently. I kind of thought it was fairly interesting, and IVR is pretty low. So I just thought it would be one to get long call spread in, kind of taking a shot here. We'll see what ends up happening with it, but that's all. It's fairly simple. It was low IVR. I liked the way that the stock was moving. I'm different in how I look at things. I usually see something like this, and I'm like, oh, maybe this stock is starting to make a move, right? We'll see. I'm keeping close eyes on it. I don't expect, again, this was more news related these last couple of days. Even still, it's fairly strong, that's some serious relative strength, I would say, on a day like this. It's not down as much. And it's healthcare. And healthcare is one of those names that I feel is going to be a little bit stronger going forward when you're talking about a recession. People still need healthcare. People still need, again, these guys create mostly experimental drugs. I think they're still going to be doing what they do. Recession is not going to affect them quite the same way as some of the other industries. So that's it. Fairly straightforward, John. That's all I was looking at. That's kind of, generally it. Markets have rebounded a little bit. We're down 2.3%. NASDAQ's down 3.2%. Russell 2000 is down 2.2%. Oddly enough, yields are kind of flat to down today, which is really kind of interesting. 30-year yields, 30-year yields are down the most. Volatility, not a huge uptick. When I look at /VX, what is that, Z22, that's December right now, not up a ton, right? Like it's not a very scary sell-off to the point of my guy in the chat here said it a second ago. This is the quietest and most boring down a nearly 3% day that we've seen in a while. It's not exactly tipping the scales here on volatility. So keep that in mind. It's not like we've perked up a whole lot when you look at DEES. And you look at, we're still 2-point difference between December VIX futures, which is 22.35, I will say, bid, and January futures, which are 24.55 bid right now. You got February at 25.40, so about almost a point difference between Feb and Jan and Feb, which is real strong contango when you look at that on a chart. Oil down 1.7%, nat gas up 6.8%. It's so schizophrenic at times. Bitcoin hasn't been able to hold on to the 18K level, and same thing with Ether, has not been able to hold on to that 1300 level. Gold is down today. It was up. I was actually surprised that it was up yesterday, or the day before, I should say, on the inflation news. Didn't really seem to make sense to me. Inflation is kind of peeling back. Why is gold up? Well, gold was up apparently because the bonds were up. The bonds liked it, gold's like it. It's like they like similar things. I have, what have I been doing? I mean, outside of, I can't remember if I've talked to you about some of the other trades. I think you guys know that I'm long these zebras and UAL. I'm long zebra and DAL. I'm long zebra and a couple of these banks in Citi and Wells Fargo. That's kind of where I'm at. I did sell I thought I kind of liked this trade. It is an S&P 500 name. It's not a name that I trade a ton, but Generac, I believe they do generators, right? Something like that. Anyway, it doesn't really matter. Over 50 vol, no earnings coming up in Jan, and I decided to sell the 20 Delta put. I kind of like the trade. Small. Buying power is on a margin account was only is just under $800, so that's probably one of the trades I'm a little bit excited about today. But other than that, not a whole lot much doing, man. It's kind of kind of quiet. Crypto moves. What do you think about AT&T as a safer bet and dividend? It's definitely a safer bet. It definitely has a dividend. I know that I believe that might already be done. I know they were possibly looking at cutting their dividend after they spun off WBD, that company, Warner Brothers Media. But AT&T is still AT&T, right? I mean, they haven't really changed their model as much, and they're still a safe company that has a dividend. So I can understand why you like it. If you like it, you like it, man. Those are the type of names that I think people are going to be playing more than usual. Let me look through here and make sure I got all of your questions in here. Options in Israel, this is the last question I can take. We got to roll after this. Looking for some portfolio strategy. What are the top 3 sector directional bets for 2023 to base a portfolio strategy around, and maybe the why with it? I would say, again, looking at some of those safer names, dividend-related names, consumer staples. I think a lot of people are looking at consumer staples for next year because they've been fairly safe, and they also many of them offer dividend, and you can sort of sometimes sell calls against those as well. If you're really looking at what has happened this year and you want to reverse trend, doesn't mean it's going to work. The idea of consumer discretionary, which has really been beat down this year when you look at the Teslas and the like that, a lot of people, I think some people are looking at the idea of getting long consumer discretionary and getting short energy. Whether that'll work or not, I can't tell you. But those are some of the things I know people are trying to structure a portfolio around. Folks, that's all my time today. Thanks for watching. And as always, be smart, be patient, trade small, trade often. Don't get tripped up out there. See you guys later.